This video is about the three massive structural traps waiting to quietly drain your retirement income in 2026 and the exact steps you must take right now to protect every single dollar you've worked a lifetime to save. Because the biggest threats facing retirees today are not always obvious. They are hidden inside the systems you depend on: Social Security, Medicare, and the IRS. In this video, I'm going to reveal the three financial mistakes seniors are making right now: the hidden cost behind your Social Security increase, the Medicare income trap that can raise your premiums, and the retirement timing mistake that can create a future tax disaster. Stay with me until the end, because understanding these three traps could help you protect your retirement income and avoid costly surprises in 2026. Now, I want you to understand something important. The biggest retirement threats in 2026 are not always the ones people expect. They are not just market crashes, bad investments, or economic headlines. Some of the biggest dangers are hidden inside the very systems designed to support you: Social Security, Medicare, and the tax rules enforced by the IRS. Many seniors are entering retirement believing that if they simply collect their benefits, avoid unnecessary spending, and keep their savings untouched, they will be protected. But retirement today requires more coordination than ever before, because these systems do not operate separately. A decision you make with your income can affect your Medicare premiums. A withdrawal from your retirement account can trigger higher taxes years later. A benefit increase that looks good on paper may not create the extra money you expect in your bank account. This is what I call the invisible retirement tax claw. Money you worked decades to earn can slowly be reduced through benefit erosion, rising healthcare costs, and unexpected tax consequences, often without you realizing it until the damage has already happened. That is why today we are focusing on protection, not chasing unrealistic returns. The goal is not to become a millionaire overnight. The goal is to make sure the retirement income you earned stays where it belongs, with you and your family. The first mistake millions of retirees are making in 2026 is falling for what I call the net COLA blind spot. Every year, millions of Americans hear the announcement that Social Security benefits are increasing. And for many retirees, that news brings a sense of relief. They hear cost of living adjustment and assume their financial pressure will ease. But the number announced by Social Security is only the starting point. What matters is not the size of your increase on paper. What matters is how much actually remains after the other costs affecting your retirement. For 2026, Social Security benefits received a 2.8% cost of living adjustment. For the average retired worker, that works out to roughly a $56 monthly increase, bringing the average benefit to about $2,071 per month. But here is where many people get caught off guard. At the same time that Social Security benefits increased, Medicare Part B premiums also increased. The standard monthly Part B premium rose from $185 in 2025 to $202.90 in 2026, an increase of $17.90 every single month. That means a portion of your Social Security increase is immediately being absorbed before you even see the money in your checking account. For the average retiree, that Medicare increase consumes roughly 1/3 of the COLA increase. And for seniors receiving smaller monthly benefits, the impact can be even greater. Someone receiving a $1,280 monthly Social Security check may see nearly half of their entire COLA increase disappear into the higher Medicare premium. And this is not the only health care cost changing. The Medicare Part B annual deductible increased to $283, and the Medicare Part A hospital deductible also increased, creating additional pressure for retirees who are already carefully managing every dollar. This is why I want you to stop looking at Social Security increases in isolation. The question is not, how much did my benefit go up? The better question is, how much of that increase did I actually keep? That is your true net COLA. And one of the most important steps you can take is reviewing your healthcare coverage every year. Do not assume the plan that worked last year will automatically be the best plan for next year. Prescription costs, coverage rules, and Medicare plan structures change. Some retirees may benefit from reviewing their prescription coverage, checking available plans, and understanding new protections like the Medicare Part D out-of-pocket limit. The second major mistake seniors are making in 2026 is stepping directly into the IRMAA cliff without realizing it. Many retirees believe Medicare premium increases work like normal taxes, where only the extra income above a limit is affected. That is not how IRMAA works. IRMAA, which stands for Income-Related Monthly Adjustment Amount, creates Medicare surcharges when your income crosses certain thresholds. And the dangerous part is that crossing the line by even $1 can move you into an entirely different premium category. Your 2026 Medicare premiums are generally based on your tax return from 2 years earlier, meaning your 2026 Medicare costs are tied to your 2024 income. This creates a problem because many retirees make financial decisions without realizing the future Medicare impact. Maybe you sold a property, maybe you took a large retirement account withdrawal, maybe you completed a major financial transaction that increased your taxable income. At the time, it may have seemed like a smart move, but that one-year income spike could follow you into your Medicare premiums years later. For 2026, if your modified adjusted gross income crosses $109,000 for single filers or $218,000 for married couples filing jointly, you enter the first IRMAA tier. And for a married couple, crossing that line by just $1 can trigger thousands of dollars in additional Medicare premiums over the year. This is why retirement planning cannot just be about how much money you have. It has to be about how your money moves through the tax system. Another mistake many families overlook is what happens after the loss of a spouse. When one spouse passes away, the surviving spouse often faces a dramatic change. Their tax filing status changes from married filing jointly to single, but their income does not always fall by half. Pensions continue, retirement accounts continue, required distributions continue. Suddenly, a survivor who was comfortably below Medicare surcharge limits as a couple may find themselves pushed into much higher costs alone. This is the widow or widower IRMAA trap. The solution is planning ahead. For many retirees, the years between retirement and required minimum distributions can be some of the most valuable planning years available. Strategic moves, such as carefully managing taxable income and considering Roth conversions during lower income years, may help reduce future Medicare and tax pressure. And if your income has genuinely dropped because of a major life event, such as retirement, divorce, or the death of a spouse, there are situations where you can request a new Medicare premium determination instead of relying on outdated tax information. The third mistake is wasting what many experts call the pre-RMD golden window. Many retirees believe the best strategy is simple: leave their retirement accounts untouched for as long as possible. And while delaying taxes may sound attractive, it can create a future problem. When required minimum distributions begin, large traditional IRA and 401k balances can create a wave of taxable income all at once. That can mean higher tax brackets, higher Medicare premiums, and less control over your retirement income. The years between retirement and your required minimum distribution age can be a valuable opportunity to create a more balanced retirement strategy. Instead of waiting until the government requires withdrawals, some retirees may benefit from gradually managing those accounts while they have more control over their income. There is another issue affecting early retirees who claim Social Security while still working. If you claim benefits before reaching full retirement age and continue earning income, you must pay close attention to the Social Security earnings test. In 2026, early retirees face an annual earnings limit of $24,480. If you earn above that amount, Social Security can temporarily withhold part of your benefits. For every $2 earned over the limit, $1 can be withheld from your benefits. And additional income can also affect whether your Social Security benefits become taxable. This is why retirement timing matters. Your retirement income is not controlled by one single decision. It is a connected system involving Social Security, Medicare, taxes, and your personal circumstances. Ultimately, when you coordinate your retirement benefits across taxes, healthcare, and income, navigating life after 60 stops being a source of fear and becomes what it was always meant to be, a time of complete freedom. If this information helped you understand the hidden traps that can affect your retirement, leave a comment below and tell me which one surprised you the most. Share this video with someone who is preparing for retirement because a conversation today could prevent a costly mistake tomorrow. And make sure you subscribe to this channel for more retirement protection strategies designed to help you protect the money you worked a lifetime to build. Remember, retirement is not just about having enough money. It is about keeping control of the money you have earned.